Welcome back to the channel. Today we're diving into how you can make the most out of a bull market, whether it's in stocks or cryptocurrency. Bull markets present incredible opportunities for investors to capitalize on rising asset prices. But navigating them effectively requires strategy and discipline. So without further ado, let's dive into the first strategy. Research and choose high-potential assets. The first step to making money in a bull market is identifying high-potential assets. Focus on industries like technology, healthcare, energy, and consumer discretionary, which tend to perform well during these periods. Look for companies with strong earnings growth, good management, and solid market positions. For instance, tech giants like Apple, Microsoft, and Google have consistently demonstrated strong performance and innovation. In the healthcare sector, companies involved in biotechnology and pharmaceuticals often show significant growth potential. In the cryptocurrency space, well-established coins like Bitcoin and Ethereum are generally safer bets due to their market dominance and widespread adoption. Research and due diligence are crucial here, as the crypto market can be highly volatile and speculative. Now let's move on to the next strategy: leverage dollar cost averaging. Dollar cost averaging, or DCA, is a powerful strategy that involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This method helps smooth out volatility and reduces the risk of mistiming the market. By consistently investing over time, you can accumulate more shares when prices are low and fewer shares when prices are high, ultimately lowering your average cost per share. Instead of trying to time the market perfectly, which is nearly impossible, DCA allows you to take advantage of long-term trends without stressing over short-term price movements. For example, if you decide to invest $500 monthly in a diversified portfolio of stocks and cryptocurrencies, you continue doing so regardless of market conditions. Over time, this consistent investment approach can lead to significant wealth accumulation as the market trends upward. Next, we'll discuss momentum and trend following as another effective strategy. Momentum and trend following are strategies that involve buying into assets showing strong performance and selling those that are underperforming. The idea is to capitalize on existing market trends, riding the wave of upward momentum to maximize gains. To implement this strategy, start by identifying assets with high relative strength compared to their peers. This can be done using technical analysis tools like moving averages, relative strength index, and trend lines. However, it's crucial to avoid overly volatile or speculative assets unless you're prepared for the risk. Focus on assets with a proven track record of performance and stability. Additionally, set stop-loss orders to protect your investments. Next up, we'll explore the growth investing strategy. Growth investing focuses on identifying companies and sectors with strong growth potential, particularly in areas like technology, artificial intelligence, cloud computing, and renewable energy. When selecting growth stocks, look for companies with a history of strong revenue and earnings growth, as well as a clear path for future expansion. Pay attention to key metrics such as revenue growth rate, profit margins, and earnings per share, or EPS. It's also essential to consider the competitive landscape and market position of the companies you're investing in. Companies with a unique value proposition, strong brand recognition, and a solid customer base are more likely to sustain their growth over time. While growth investing can offer significant rewards, it also comes with higher risks. To mitigate this risk, diversify your portfolio across multiple growth sectors and companies. Next, let's look at swing trading as a strategy for short to medium-term gains. Swing trading is a strategy that involves using technical analysis to buy stocks or assets and hold them for a few days or weeks to capture short to medium-term gains. The goal of swing trading is to capitalize on price swings within the broader trend, allowing you to profit from smaller, more frequent trades. To get started with swing trading, you'll need to familiarize yourself with technical analysis tools such as moving averages, candlestick patterns, and volume indicators. One of the key advantages of swing trading is its flexibility. Unlike day trading, which requires constant monitoring and rapid decision-making, swing trading allows you to make informed trades over a longer time frame. However, swing trading also requires discipline and a well-defined trading plan. Set clear profit targets and stop-loss levels for each trade to manage your risk effectively. Next, we'll discuss options trading for advanced investors. Options trading is an advanced strategy that can offer leveraged returns, but it comes with significant risks. In a bull market, call options can be particularly profitable, as they give you the right to buy an asset at a predetermined price, allowing you to benefit from rising prices. To get started with options trading, you'll need to familiarize yourself with key concepts such as strike prices, expiration dates, and the Greeks, delta, gamma, theta, and vega. One of the main advantages of options trading is leverage. With a relatively small investment, you can control a larger position in the underlying asset, potentially leading to higher returns. However, this leverage also means that losses can be magnified, so it's essential to manage your risk carefully. Use strategies like covered calls and protective puts to hedge your positions and limit potential losses. Next, we'll cover risk management techniques. Risk management is a crucial aspect of investing, especially in a bull market where the potential for gains can sometimes overshadow the risks involved. One of the most common techniques is using stop-loss orders, which automatically sell your assets if they drop to a predetermined price. Diversification is another key component of risk management. By spreading your investments across different asset classes, sectors, and geographies, you can reduce the impact of any single investment's poor performance on your overall portfolio. Taking profits gradually is also an effective risk management strategy. Instead of holding on to your investments indefinitely, consider selling a portion of your holdings when they reach certain profit targets. This approach allows you to lock in gains while still participating in the market's upward movement. Additionally, it provides a cash buffer that can be used to take advantage of new investment opportunities or to weather market downturns. Finally, stay informed and continuously monitor your investments. Next, we'll discuss the importance of following market sentiment. Market sentiment refers to the overall attitude of investors toward a particular market or asset, and it can have a significant impact on price movements. To make the most of market sentiment, it's important to track news, trends, and sentiment indicators that can provide insights into market direction. One way to gauge market sentiment is by following financial news and analyst reports. Social media platforms and online forums can also be valuable sources of sentiment analysis. Platforms like Twitter, Reddit, and specialized investment forums often provide real-time insights into what investors are thinking and how they are reacting to market events. Sentiment indicators such as the Fear and Greed Index and the Volatility Index, VIX, can also help you understand the prevailing mood in the market. By incorporating sentiment analysis into your investment strategy, you can make more informed decisions and better navigate the bull market. Next, we'll explore alternative investments. In addition to traditional stocks and cryptocurrencies, alternative investments can play a crucial role in a diversified portfolio, especially in a bull market. Alternative investments include assets like commodities, real estate, private equity, and hedge funds, which can offer unique benefits and help balance your portfolio. Commodities like gold and silver are popular alternative investments due to their historical role as safe haven assets. Real estate is another valuable alternative investment. Investing in property can provide steady rental income and potential capital appreciation. In a bull market, real estate values often rise, making it an attractive option for investors seeking long-term growth. Private equity and hedge funds are more complex alternative investments that typically require a higher level of expertise and capital. While they can offer substantial returns, they also come with higher risks and less liquidity. Next, we'll discuss the importance of keeping an eye on the macro environment. Understanding the macro environment is essential for making informed investment decisions in a bull market. The macro environment includes factors like interest rates, inflation, government policies, and global economic conditions, all of which can have significant impacts on market performance. Interest rates play a crucial role in the macro environment. When interest rates are low, borrowing costs decrease, encouraging consumer spending and business investment. Conversely, rising interest rates can slow down economic activity and put downward pressure on markets. Inflation is another critical factor to monitor. Moderate inflation is generally positive for the economy, as it indicates growing demand and rising prices. However, high inflation can erode purchasing power and lead to higher costs for businesses, potentially impacting their profitability. Global economic conditions, including geopolitical events and international trade dynamics, can also affect the macro environment. Next, we'll discuss the importance of remaining disciplined and avoiding FOMO. One of the biggest challenges in a bull market is remaining disciplined and avoiding the fear of missing out, or FOMO. The excitement of rising asset prices can lead to impulsive decisions and over-leveraging, which can ultimately result in significant losses. To succeed in a bull market, it's essential to stick to your investment plan and maintain a disciplined approach. Start by setting clear investment goals and a well-defined strategy. Determine your risk tolerance, time horizon, and desired returns, and develop a plan that aligns with these objectives. This plan should include specific criteria for buying, holding, and selling assets, as well as guidelines for managing risk. It's also important to avoid over-leveraging, which involves borrowing money to invest in the market. While leverage can amplify gains, it also increases the risk of substantial losses. Another key aspect of discipline is managing emotions. Next, we'll cover the importance of tax planning.